Hello, and welcome to my virtual classroom where we will be learning more about cost analysis for decision making. Now, this chapter really relies heavily upon what we learned in chapters 1 and 2 as far as the contribution margin income statement and a lot of the terminology that we learned. So let me get this in presentation mode so that you can see it nice and clear. And we'll move forward. So let's begin by talking about differential analysis. Now, back in chapter 1, we discussed that a differential cost is a cost that differs between two alternatives. So I can either continue to take the bus and pay $1,000 for a year, or I can purchase a car and not have to take the bus anymore, and the car will cost me $10,000. So there is a cost that's associated with taking the bus, and then there is another cost that's associated with actually getting a car, and those costs differ between alternatives. We're looking at differential analysis from the perspective of a short run and a long run. Short run, I'm looking usually at 1 year, where capacity is typically unchanged. And we're talking about capacity, we're talking about if we're working in a production facility and there are a certain amount of units that production facility can produce over a year, typically capacity is unchanged from 1 year to the next. When we look at decision making in the long run, then capacity does change, and we'll have to consider some different factors. So just again, to refresh your memory, a differential cost is a cost that differs among or between alternatives. And we can also have a differential revenue as well. And that's a revenue that will differ between two alternatives. When making any decisions, we want to make sure that we are not considering sunk costs. A sunk cost is a cost that happened in the past. And because it happened in the past, I can't change that cost by any decisions I make right now or by any decisions I make in the future. And a lot of people run into this issue, especially with investing. Sometimes you invest, and let's say you put $1,000 into a particular stock, and then the stock tanks and you discover that the company is not going to do well in the future. Some people will still hold on to that stock because they're thinking about the $1,000 that they put out a few months ago to get the stock. Well, the $1,000 you're never going to get back. You already paid for it. Now, I know if the value of the stock had increased, then you would think, okay, if I sell it, then I can at least recoup the $1,000 that I invested. But the money that you get from selling the stock is a completely different cash flow. So the $1,000 that you paid in the past, it happened in the past. You can't change it. Whether you sell the stock today or not, the $1,000 is still gone. So when we're making decisions, never consider a sunk cost. It is irrelevant for decision making because you can't change it. It's already happened. Now, differential costs may not be the same as total costs, because sometimes when you're looking at what's going on right now, which is a status quo, and a particular alternative, meaning information has come to your attention and you were able to take advantage of an opportunity, and that's what the alternative cost would be of that opportunity. And looking at that, sometimes there are some costs that remain unchanged, like fixed costs in this example. So total costs will be different from the differential cost. Differential costs, I'm just comparing the two alternatives, and it makes it easier when I'm looking at information. I'm not overwhelmed with all these numbers. If I want to know what's going on, what's going to be my change in profits by accepting this alternative, then I can just look at this last column and I can see that profits will increase by $100. And usually in my head, if I'm making more money, then that is the alternative that I want to go with. So when looking at differential analysis, and again, differential analysis, I'm just comparing what's going on right now to what would happen if I take advantage of a particular opportunity. Variable costs of that alternative always have to be covered. Fixed costs can be covered in the long run. So this brings back the short run decisions versus long run decisions. If I'm looking at the short run, those variable costs have to be covered, because remember, variable costs change with the level of activity. So if I'm choosing this alternative, then I'm expecting my variable costs to go up. Fixed costs may not go up. They may go down. It just depends on what's going on in that situation, but I have more time to cover my fixed costs because they can be covered in the long run because they're shared. So again, short run pricing decisions, I'm looking at less than 1 year, and an example of that would be a one-time special order. Long run pricing decision would be pricing a new product. So that product's going to last me for several years, and some of those costs I can cover in the future. So the pricing decision covers more than 1 year. But with that one-time special order, it's a one-time deal, and it's going to impact my costs in this year, typically not impacting capacity. But a new product will definitely impact capacity in the long run. So on this particular side, we're trying to determine whether or not we should reject the special offer or accept the special offer. Status quo, again, is what is going on right now without the special offer. The alternative is what my costs would look like and revenues, what they would look like if I accept the special offer. And if I accept the special offer, I want to see my profits increase. If my profits happen to decrease, then I'm going to reject the special offer. Now we are assuming that with a special order that it's not going to impact our other sales, and it's only going to happen one time. If it's going to cannibalize my other sales or decrease capacity such that I can't meet my other sales, then I'm not going to consider it because I'm cannibalizing the profits that I'm making right now. But a special order typically happens when my production facility has a capacity of say 10,000 units, and I'm right now running at 7,000 units. I get a special order that asks for 1,000 units. I can handle it. My capacity is at 10. I'm only working at 7 right now. So doing an additional 1,000 units isn't going to hurt me. So what you see listed here, these are my current costs at status quo for UDevelop. And UDevelop has received this one-time offer for 500 prints at a special price of 40 cents per print. So typically this company is producing prints right now. The regular price is 50 cents. Now they get this special order of doing it, just these 500 for 40 cents. Should they take on this offer? Now, without looking at any of my costs, you may immediately say no, because the special order is 40 cents and I get a regular price of 50 cents. But that is not the way to make this decision. We have to do a full analysis of not just the differential revenue, but also our differential costs. So in this example, the company has enough idle capacity in the week to take the offer. So what we're going to do is we're going to look at what would happen if we reject the special offer and we just keep things status quo at what they are right now. We have a profit of $300. Now, if we accept the special offer, notice that revenues go up by the 200. Variable costs will increase as well, but our fixed costs remain the same. So even though variable costs increase, our revenues increase by more than those variable costs. So we end up having an operating profit of 400. Or if we want to do it the quick and dirty way and quickly look at the difference, we can see that our operating profit will increase by 100. Our differential costs are just our variable costs. Our differential revenue is the sales revenue. Fixed cost is not a differential cost. It remains the same between both alternatives. So yes, we would accept this special order because we get an increase in operating profit of $100. Now, that was an example of short run special order. Let's look at a long run pricing decision where we're looking at perhaps developing or making a new product. When looking at long run pricing decisions, we want to make sure that we take into consideration the full cost. Now, in our previous chapter, in chapter 2, we saw different ways that we could calculate our product costs. We could only use variable costs, so we could use variable marketing and administrative costs and variable product costs, or we could use full absorption costing where we only look at our product costs, so just materials, labor, and overhead, or we could do full costing. And this is where we take every variable cost, every fixed cost that we have, whether it is a manufacturing cost or a marketing cost. We don't care. We take all of the costs. Well, when you're making a pricing decision in the long run, you always want to use that full cost. Don't just use variable costing, because remember, in the long run, we have to cover those fixed costs in the long run. So we want to make sure that everything is included. In the short run, differential costs can be low, but in the long run, because we're covering several periods, those differential costs may be higher. So we're looking at more information here. In the short run, typically our fixed costs don't change, so we only have to cover those variable costs. But in the long run, again, those fixed costs can change, so we have to look at full product costs. Now, product life cycle costing is concerned, or it revolves around making sure we can cover all of the costs associated with developing our products and ultimately disposing our product if we're responsible for disposing, depending on what type of product we make. So we're looking at all the different costs associated with all of these different activities. Again, that's that long run decision. When we're looking at something in the short run, a lot of times it's just a manufacturing cost that we need to cover. We've already done the research and development, the design, but when we're looking at creating a new product or long run decisions, we have to take into consideration the entire life cycle of the product. Now, one of the methods that we can use to help us with this decision is called target costing. So with target costing, we first develop the target price. So we'll have our marketing people do all the homework, and they'll determine what would a customer want to pay for the goods that we are trying to offer them, the goods or services that we are trying to offer them. They'll look at what competitors do, they'll do surveys, they'll do market research and analysis, all these different things, and we determine how much a customer will want to pay. And then we say how much profit. We talk to our accountants, we talk to our CEOs, how much profit do we need to make? So then we back into our costs. So normally we're used to seeing our sales price minus our cost gives us our profit. But we back into our costs by finding our price and then our desired profit. And then we say, can I afford to make this at this cost? Is it reasonable to say I can make this product at this particular cost? Sometimes I can fall within those parameters, and sometimes I can't. I have to go back to the drawing board and look at my target price, look at my desired profit, or just table the entire project. Now, this is different from what used to be done, because what used to be done was we would say, how much does it cost us to make this product? Okay, it cost us $25 a unit. Well, I want to make sure that I make a profit, so I'm going to set my price based on how much it costs me to make this. And in doing so, we may be overpricing our goods, especially when there's a company in the market already that's more efficient and can do it for a cheaper price. So this way we can make sure that we are being efficient and effective by focusing on quality in the eye of the customer, by looking at what the customer would want to pay. Now that wraps up this video where we looked at a brief overview of differential analysis. I showed you an example of a short run decision with special ordering. In the next video, we're going to look at legal issues related to pricing, because we also saw how to price out our product, and we're also going to look at in more detail long run pricing decisions. So I appreciate your time and attention, and I hope you have a great day.